Welcome back, everyone. We've heard from Klaus and Brian about how the sovereign debt crisis will affect the economies and currencies of some of the world's biggest countries, including our own. But what specifically can investors do to protect themselves and turn a profit? Our producer, Jen Amos, asked the other editors of Weiss Research that very question, and she's compiled their responses. Hello, Jen. So good to see you.
Thank you for having me back. I might become a regular.
Well, we would love that. Okay, so how are the editors suggesting that we play out this sovereign debt crisis?
If the crisis does flare up again, like it did in Greece earlier this year, the likeliest outcome will be a big drop in European stocks and a continued decline of the euro. Our ETF expert, Ron Rowland, suggests two funds that would benefit from those trends. The first is the ProShares Ultra Short MSCI Europe, which is designed to move inversely to the European market. It has 2 times leverage, so for every 1% the MSCI Europe index drops, you'll make 2%. If you want to bet against the euro currency, Ron recommends the ProShares Ultra Short Euro Fund. It's also leveraged, meaning gains and losses will be magnified, so you have to be careful. But you can see that it's had a nice run over the past year. So if you're willing to make an aggressive bet on continued devaluation of the euro, this ETF could pay off very nicely.
Jen, any ETFs out there that investors should stay away from?
It may seem obvious, but you should avoid ETFs that hold a lot of sovereign debt. Ron points out that more than half of the Spider Barclays International Treasury Bond Fund has direct exposure to European debt. It also holds Japanese debt, and Japan is in just as much danger as any European country.
I would imagine here the editors are also warning about banks that hold sovereign debt as well.
Right. European banks especially would be a risky play for investors right now. Mike Larson, who we'll be hearing from later, says to stay away from Deutsche Bank, Germany's biggest lender. It recently announced that it's raising more than $12 billion in capital to expand its retail banking business. That would be too little, too late if another European country needs to be bailed out like Greece. And speaking of Greece, Tony Sagami's pan this week is that country's largest lender. National Bank of Greece holds a mountain of Greek sovereign debt. It recently reported a 68% drop in its quarterly profits, and it's facing a wave of loan defaults.
Jen, any safer plays in the European banking sector?
It's doubtful that any European banks are going to offer solid returns, but one that might outperform its competitors is Spain's Banco Santander. Nilas Mativ points out that it pays a dividend that yields its investors more than 4%, so that could help insulate the stock during another downturn. But its shares have actually enjoyed a bit of a bump recently, so Nilas says he would wait for another dip before buying.
Jen Amos, so good to see you. Thank you.
Thank you for having me back.
Coming up next, John Brown of Euro Pacific Capital and Sherman Goodrich of Franklin Templeton Investments tell us whether they think another round of the sovereign debt crisis is coming and how they're protecting their clients. Plus, a closing comment from Mike Larson. Money and Markets is back in just a moment.